Howdy, Jacob here. Today we're looking at FormFactor in the semiconductor and equipment industry. They manufacture and sell probe cards, analytical probes, probe stations, metrology systems, among other things. Incorporated in 1993 out of California. 2.9 billion market cap, 2.6 billion enterprise value, more net cash than debt, which is great. And growth of the company has been very impressive. Looks a little bit cyclical, as we could see from as high as 43% revenue growth and as low as negative 11%, but still definitely pointing in the positive direction. Return on invested capital, not super fantastic. It looks like they are seeing both growth in both gross and operating margin, which is a positive. But again, return on invested capital, upper single digits, nothing crazy impressive there. Good amount of money going to R&D, well over 10%, probably closer to 15% of revenue being expensed as R&D. Again, taking money away from today to hopefully make more in the future, be more efficient. Not everything is going to hit, but the things that do hit will hopefully really hit that bottom line and increase profits and cash flow. Balance sheet shows over $300 million in cash-like products and short-term investments with $1 million short-term debt, $12 million long-term debt, much more cash on hand than debt. Definitely not concerned with that balance sheet and feeling good about possible opportunities for cash deployment. We see good increase of cash from operations, but also a good increase of CapEx. However, free cash flow in total is still growing, and majority of that cash flow is going to reinvestments. Been some sell-off of acquisitions lately. Historically, they've paid down some debt, bought back shares, but I think a majority of this money is going to be going to reinvesting, essentially. And I think that's enough to make some assumptions. So for revenue growth here, we've seen a lot of growth. Can they contain this? I think with a lot of money going to R&D, a lot of money being reinvested back into the business, I think they'll be able to keep a pretty heavy growth rate. I think their return on invested capital being as not quite as impressive as I would like. I think just slightly above market average, even with the heavy growth for them, makes sense to me. And then for margins, they're kind of all over the place. Let's look at net margin and free cash flow margin. Maybe 10, probably around that 10% mark. So maybe let's do 11 and 10% with share change of, they're buying back a little bit, but they're issuing a bit more through stock-based compensation, net 30 million. So let's increase that 1% a year. And we're saying it's 73% drop is required before you get the return we look for here. So I do think great company, although return on invested capital is not very impressive. I think that they're reinvesting a lot, and so that's going to dampen your numerator as it's based on net operating profit. And so when you take a lot of money away from today to hopefully make more in the future, that will dampen that ROIC figure. And so still pretty impressive from what I'm seeing from a company-wide view, but from a price view, again, not at something that I think is a squealing deal. Hope you enjoy this video. Have a great rest of your day.